Hello, I'm Jonathan Moyes, Head of Investment Research at Wealth Club, and today I'm with Jim Vanek of Apollo Global Management to talk about the investment opportunities in private credit. Hello, Jim.
Hello,
Welcome
Jonathan.
to the studio. Good to have you here. For those who aren't familiar, could you start by giving us a bit of background to Apollo and your own experience?
Absolutely, and thank you for having me here. It's a pleasure to be able to speak to Wealth Club about what we believe are very exciting opportunities for its clients. My name is Jim Vanek. I'm a partner at Apollo. I'm the co-head of performing credit, and I've been at the firm for 15 years. So Apollo is one of the largest alternative investment managers in the world, with 30 years of experience investing across private equity, credit, and real estate. We've focused throughout our history on a few core principles that we think are extremely important when it comes to investing in all of these markets. The primary principle is purchase price matters. That means investing in assets at a price which provides downside protection for its investors. We think about generating excess return per unit of risk, which is an element of purchase price matters. That means generating enough return based on the amount of risk we're taking in any investment for it to make sense for our client. And then alignment. Apollo is unique across alternative investment managers, given our relationship with Athene, which is the retirement services business that we founded 14 years ago. Essentially, half of the $600 billion of assets under management that we invest represents our own balance sheet, which is a very unique perspective for investors in our firm.
And your own experience?
My own experience at the firm over 15 years has encompassed trading, portfolio management, and then being responsible for our private credit business.
And so we're here today to talk about private credit. Firstly, what is private credit?
Sure. So private credit is an extension of how lenders interact with borrowers in the leveraged finance space. Traditionally, borrowers have accessed credit through the public markets, primarily the syndicated loan market and the high yield market. Private credit is an extension of that, which allows lenders to extend credit directly to borrowers, negotiate terms and credit agreements with their counterparties, negotiate pricing, and also structures that make the most sense for the businesses that we're lending into. That happens directly, not through the conduit of a bank, not through another intermediary, and allows firms like Apollo to again, deal directly with borrowers.
And it's been growing in popularity amongst institutional investors for some time now. Why do you think this is?
You're absolutely right, it has. For investors, private credit makes a lot of sense. It's attractive in any return environment, but it's incredibly attractive right now, given the return profile, the forward return opportunities, and the yield available within credit. Private credit also allows investors to interact with managers who are negotiating credit agreements directly, which means the terms and structures and protections they get as a lender are more attractive than you typically get in the public markets. Additionally, the volatility profile of private credit is usually much more attractive than what you're going to get in the public markets, given the nature of borrowers interacting directly with lenders.
And so, Jim, we've seen interest rates increase over the past 2 years, we've also seen spreads widen, which is helping with yields on private credit. On the flip side, credit is now much more expensive for companies. So how do you have the confidence that these companies can continue to service these loans? How do you deal with that side of the equation?
So that dynamic is very important because you're absolutely right. The return opportunity is very attractive, but the offset to that is that the capital that companies need in order to operate is more expensive, and that's a stress on their cash flows. What we're seeing is companies that are borrowing on a floating rate basis and paying more for that debt are offsetting an increased interest expense by cutting down on CapEx, potentially cutting down on spend for research and development or sales and marketing in ways that are going to influence their business going forward. And it's an important element to think about when you're lending into a company. One of the reasons we're focused on large cap borrowers is that we feel they're better able to offset higher degrees of interest expense without cutting what are existentially important elements of their business going forward to a degree that's going to hurt them in the medium or long term. But understanding how companies are able to deal with the fact that interest expense is elevated right now is a really important element of what we think about when we're lending into any company.
And so why would the company borrow money in the private markets rather than just issuing investment grade or high yield bonds?
Sure. So there are a number of reasons. The primary reason is assurance of execution. A company borrowing in the private markets isn't dealing with a bank that, again, is acting as an intermediary between the borrower and the eventual lenders and isn't actually the lender itself. When a company is borrowing in the private market, they can negotiate terms and pricing with the holder of the debt. And we intend to purchase debt from a borrower and really hold that to maturity. We also can customize capital structures to make the most sense for both borrowers and sponsors in a way that fits their business model and gives them the best chance to achieve their goals as it relates to growth, as it relates to what they want to do with the underlying company. And finally, we can deal with companies of all different types, new borrowers in the market, companies that may not necessarily have been issuing high yield or investment grade bonds previously, in a way that's difficult to do when you're a company that's working through a bank that's not actually going to be your lender.
Yep.
Because we're going to be the end owner of that asset, we can think through what the outcomes are for a certain business in different underlying economic environments in a way that makes the most sense for both parties.
So finally, to sum up then, Jim, for private investors, why should they consider investing in private credit?
So credit right now on its own is extremely attractive, given the return opportunity in a way that historically hasn't been available. Typically, you're not able to invest in, again, first dollar, first lien, senior secured credit and achieve the type of returns that are available in the market currently, which is why we think investing in credit is an important element of any strategy at the moment. Private debt as an element of investing in the credit markets, in our mind, is incredibly attractive because, again, you can enter into highly structured loan agreements with very big companies, take first dollar risk, generate very attractive yields with spreads to what's able to be achieved in the public markets that are very attractive, and do so with a high degree of subordination in the form of equity that comes in beneath these loans, in a way that we think is both prudent, conservative, and again, very attractive given the return characteristics.